kind of, this is the second question that I have for you, Jared. You had talked about long-term perspective versus short-term and doing things to sacrifice, sometimes sacrificing the short-term gains in order to achieve a more sustainable long-term gains. Like, kind of reminds me almost in that stock market where, you know, the CEOs live and die by the quarterly reports kind of situation. In the investor community, in the syndication space, and I know you don't raise capital, right? But for the people who are on this call that are LPs or are GPs, what would you say to them in terms of when they're talking to the operators to find out what kind of perspective that they have versus are they looking to pop those short-term gains and try to get out of that property? Because right now in 2022, that no longer works. You know, that probably worked in 18, that worked in 19 just fine, that worked in 20, that quick pop, you get your, you know, 30% IRRs and you post it all over LinkedIn of how amazing you are. You've seen, I'm sure, a couple dozen of that. Today, 2022, completely different, right? It is about that long-term perspective, and it's going to be about an extended time period with lower IRRs. And how does an investor today speak to an operator and figure out if it's someone that's stuck in that short-term mindset and that just is going to be looking to get out in 2 years, which may not happen with the interest rates being what they are, or someone that can extend that deal and, you know, show that empathy to their tenants, but at the same time produce a good solid return in the long run?
That's a great question. I'd want to brainstorm some, but a few things come to mind. For me, a lot of it is just it starts to become apparent in their assumptions. Of course, asking when they're showing an IRR, what is their exit? What year is that an exit? And what is their exit cap rate? More operationally, though, I would want to know about their infill plan. Specifically, how are they financing it? How are they planning to sell those homes? Are they planning to do rentals? Are they planning to do rent to owns? A hallmark I've seen of the quick flippers, the people who say, look, I'm going to get the numbers big and I'm going to sell it. It's like a bum rush to get those numbers up, which is part of the plan. As Fabio, I would bet that the park that Fabio was, his new park that he was just meeting the new residents, I would bet that they've been there on average more than 10 years. Most of my tenants, I think the average is like 13 or higher years. There's a lot of stability and there's a lot of management benefit. And I think there's a lot of long-term ROI benefit. And again, if you're sharp and you can do a quick turnaround, that's great. If the wind's in your sails and the market's helping you out. But if you want to sort of future-proof that investment, I would be looking at their exit strategies for these homes, how they're going to infill, and is this a quick, if they're thinking longer term, they should be looking for more stable tenants, people who are, you know, able to qualify for a loan and buy it from them. This is one thing that just kind of popped into my head. I would just continuously question their assumptions. It's hard to hide.
Which assumptions would you focus on? You want to come back to it?
Yeah.
Yeah,
it's a good question. Fabio, I'm curious if you have any ideas.
Fabio, are you there?
Sorry, what was that? Sorry, the service is cutting in and out.
So,
yeah,
so
thinking about
go ahead, Jared.
Thinking about how to sniff out an operator who is really relying on a short-term exit and particular assumptions that you could question that would help any LP who's trying to get a feel for the thinking of a potential deal sponsor.
I mean, honestly, other than if it sounds too good to be true, it probably is. And
yeah,
I don't know. I mean, I'd love to say it's just experience level, but I've never invested it as an LP in a deal. And I just try to think of my own deals as a reference point. And if I were to pitch, I mean, even Bradley Beach, but we're way ahead of timeline on that. But even the mobile home park, that was a huge turnout last year. If I pitch as an LP, we're a full year ahead of where we thought we would be. So I can't say experience, and that was our first mobile home park turnaround. So I can't say experience is necessarily an indicator, but if people are not, if they're just not conservative in their numbers and it seems fishy, it probably is. I would have undersold, what we would have tried to do. It's just like anything else, under promise, over deliver. If someone's over promising from the get-go, that's a red flag.
Yeah, I think to really go into depth, it would be you can research, and these are pretty easily accessible. How to flip a mobile home park. You can start to sniff those. This is kind of sound silly, but so many of the people, there's like a standard playbook when they're going to say, I'm going to put in white vinyl fencing and put up a new sign. I know where they got that. I think that anybody who's interested long term, that means that they're planning to stay with the property. That means they're going to be staying in bed with the residents. You got to remember, if somebody is not moving their home, if the average tenancy is 13 years, you care who that person is. So the more that they're focusing on tenant quality and the process of getting new tenants tells me that they're interested in staying long term. Because any mom and pop that I know, the most hands-on operators, that they might only have 1 or 2 communities, but they get every drop of juice. They have, like Fabio said, tenants who just love them. They will pass up on a good resident. On a profitable home sale, if they think that resident is going to give them any sort of trouble. That is just like a hallmark of somebody who's in this business long term. It's about the lot rent, and it's about that long term.
We're going through that right now with our home sales. I mean, I could care less if they're making a full price offer. If their background story doesn't check out and they sound sketchy, I mean, that's our headache for forever potentially. Not not just for the short term. So you got to be really careful. The other thing I would add to vetting an LP and an aggressive business plan is just ask how and keep asking how and who. I mean, for us, for how we operate, we got super lucky and just have an amazing partner who knows how to do infill and can source homes like nobody else can do. If some operator, new operator says they're going to turn on a park and do 5-6 infills a year, ask them how they're going to do that. Where are they going to find their homes? If they tell you Facebook Marketplace and how they're going to fix them, they say they're going to find a contract, then they don't have shit lined up, and they're not going to meet their timeline, not even close. So if you just dig into the details, usually LPs who are full of it will give you, answers that are just what they are, surface level answers without any real thought into the details of how they're actually going to execute.
This is getting the juices flowing. So, and I want to get specific. I gather you're trying to get some specifics, Dennis. So, for example, if their strategy is filling it in with used homes, which is usually a requirement, but often a requirement in softer markets with lower average home sale prices, and they say that they'll be able to infill 5 a year, 10 a year into a community, whatever it is. That the next question that Fabio said, how are you going to do that, is a big one. And what you need to know that you might not otherwise know is that bringing in used homes is the biggest grind in this industry, to be able to source a used home, transport it, set it up on site. And the reason why it's not scalable, because you can call a factory and order 20 homes a year, but to get used homes, you have to go home by home by home. The next thing is it's a mess because until you're ready to move the home, which could take weeks, or if you're moving quickly, you're paying lot rent where the used home is. You're dealing with, if that's on a community, you're dealing with them. You're piecemealing a mover, somebody who would break the home down, which might be different from the truck that pulls up, delivers the home. Then these homes, presumably you're buying them because you can't, the market requires you to have a low cost home, which means you're paying very little, which means this is an old home. So now you're transporting an old home down the road. The old home down the road incurs damage. You get on site and now you have to repair an old home. Older homes are harder to repair because they used to use non-standard sizing on doors, windows, and everything. So it's almost expected that, I mean, to have, no matter, even if you bought a used home for $1,000, which already is a hard thing to find, you're going to be into it for at least $25,000, $30,000 when you have it set up and ready to sell. You got to ask yourself, and realistically, that's probably more today. There's been a lot of inflation. So this is a grind, and I've seen so many people start and fail at this miserably and pull their hair out. So if they say that, it's not that people don't do it, but that means they've got an established operation. So they should be able to point to communities where they've done this repeatedly. They need a team. If they're an operator who's small and they're saying they're going to do this in-house, I would be shocked if I don't know anybody who would say that twice. They'd have to have a team out there. They'd have to have a rehab team. And for that, they'd have to be doing it at scale. So somebody who's making the used homes part of their strategy, I've seen it, and I've seen it in states where they're not required to install. And then doing due diligence, this is like in the Midwest, doing the due diligence, I saw that they were putting up ads that say you don't have to pay a security deposit. You don't have to pay your first month's rent. You could just move in. When I inspected their accounts receivables, they were about 30% delinquency, but their occupancy shot up and their rent roll shot up.